Hey everyone, welcome back to Corporate Coder, the place where we decode the complex world of big business reports to bring you the juicy insights you crave. And let me tell you, this latest filing is a doozy. We're diving into Newbridge Acquisition Limited's IPO prospectus, a rather fancy term for a company about to go public and spill all its secrets. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we break down these filings even further. So what's the big story here? Well, like many companies, they're looking to raise a cool $50 million by selling units of their business. And these units are a package deal, one share of their company, and a little bonus, a right to get a fraction of a share later on if they actually manage to buy another business, a process they call an initial business combination. That's right, Newbridge Acquisition Limited is a blank check company, a company that exists solely to raise money and then go find and buy another company. Think of it as a company in waiting, ready to merge with someone else. They haven't found that someone yet though, and that's a huge part of the risk here. They want to do this deal quickly after this whole thing is official. Management is from Hong Kong and has ties to China, and that brings a whole unique set of risks we'll get into. They're calling themselves an emerging growth company, which basically means they get to follow slightly less strict reporting rules for a while. It's like getting a temporary pass in the corporate world. This is important, folks. This is just the draft version the company is putting out there. To get ready to sell shares, not the final deal. So they're planning to sell 5 million of these units each at $10. That's a lot of money. They've also given their underwriters an option to sell even more if things go well for another 750,000 units. Here's a critical detail. They have only 15 months to find a business to acquire and merge with. If they don't, they have to return the money to investors. They can extend this time up to 21 months, but it costs them money and they have to put more cash into this special trust fund to do it. Who's behind this venture? Well, the big player is WealthPath Holdings Limited. They're the sponsor, and they've already put in some money buying shares before this public offering at a ridiculously low price. This means if the company does well, they stand to make a huge profit even if public shareholders don't do as well. This is a classic SPAC dynamic and a big red flag for potential dilution. This sponsor is buying 175,000 units for $1.75 million of their own money. It shows commitment but also highlights the potential for conflicts of interest. They've already bought over 1 million shares for just $25,000. That's pennies per share compared to the $10 public investors will pay. This is the core reason for immediate and substantial dilution for those buying in this offering. This is a major risk factor they could push for any deal just to get their money back and make a profit, even if it's not the best deal for public shareholders. It's all about getting that initial business combination done. Now, let's talk about dilution, specifically something called net tangible book value per share, or NTBV. This basically tells you how much actual hard asset value is behind each share. If everything goes as planned with the underwriters selling all their extra shares and all possible redemptions happen, the value behind each share is projected to be around $7.82. But remember, you're paying $10 per share. That means right off the bat, you could be looking at a dilution of over $2 per share. That's a 20% or more drop in immediate value. That's a big chunk of change lost before the company even does anything. Right now, there's no stock market for this company. They're hoping to get listed on NASDAQ, but there's no guarantee that will happen or that it will stay listed. They are based in Hong Kong and have strong ties to China. This is a significant risk factor. They might consider buying a Chinese company, and the Chinese government has a lot of power and can change rules very quickly. This could impact their ability to operate and the value of your investment. Because of their foreign ties, they might face hurdles with US government reviews if they try to buy an American company. This could limit their options and add delays or even block a deal. Again, Chinese government influence is a big worry. They could step in at any time and disrupt plans. They are specifically avoiding companies structured in a certain way in China called Vs, which are a way to get around foreign investment rules. This might limit their choices even further in China. Their auditor is based in Singapore. This is somewhat good news because it means they might be less affected by US government rules about inspecting auditors in China. So they are using those less strict reporting rules. This means less transparency for investors, which is never ideal. Let's look at the money side. They're selling units for $10 each. The underwriters take a 15-cent cut per unit. That adds up to $750,000 in discounts for the underwriters from the main offering. Almost all the money raised, $50 million or more, will be put into a special trust account. This money is meant to be used only for buying another company and can't be touched for anything else until that deal happens or until they have to give the money back to investors if no deal is found. Looking at their financial snapshot as of June 30, 2025, things are still very early. They have a working capital deficit of over $600,000, meaning they owe more than they have in readily available cash to cover short-term expenses. Their total assets are barely over $160,000. This is typical for a company that hasn't started operations yet, but it underscores how much they need this IPO money to function. Then the liabilities are over $600,000. This means they're in debt more than they have actual cash on hand. Now for the dreaded risk factor section though, it's critical reading. They mention a substantial doubt about their ability to continue as a going concern. This is a big warning sign that they might run out of money if this IPO doesn't work out. That 15-month deadline is a huge pressure point. It means they might rush into a bad deal just to meet the deadline. Target companies know this and can use it to their advantage in negotiations. This is a key takeaway for investors. You don't have much say in which company they buy. Your main power is to get your money back by redeeming your shares if you don't like the deal. Even the money in the trust isn't completely safe. If lawsuits happen, that money could get used up, meaning you might get back less than your initial investment. There's a big risk that their stock could be delisted from US exchanges if the US government can't properly inspect their auditors. This is especially relevant because of their China ties. Let's get back to dilution because it's a big deal. This table shows just how much value is lost on paper for public investors. Even if everything goes perfectly with the underwriters selling all their shares and no one redeeming their investment, the net tangible book value per share is only projected to be around $7.62, but you're paying $10. So that's a $2.38 immediate loss per share for you, the public investor. That's a hefty price to pay just to get in the door. Looking at their capitalization, they have minimal debt, but also very little equity outside of what they're raising. The numbers show they are essentially running on fumes with most of their capital tied up in that trust account. Their stated business strategy is to find companies in emerging markets focusing on green energy, tech, AI, and healthcare. They want to buy small to medium-sized companies valued between $650 million and $2 billion. They have some experience in SPACs, which is a plus, but past performance isn't a guarantee. They aim for companies with strong growth potential and competitive advantages. They really value companies with strong ESG or environmental, social, and governance standards. They reiterate the risks of dealing with China. Government crackdowns on industries like tech and education are a constant concern and could impact any target company they acquire. They are avoiding a specific type of Chinese business structure to stay compliant. This could narrow their options. In their financial discussion, they confirm they have no operating history and no revenues yet. They expect costs to rise significantly as a public company and acknowledge they are not a going concern without success from this IPO. They mention the sponsor agreeing to cover certain claims that might eat into the trust fund. However, they also admit the sponsor might not have enough money to actually cover those claims. This is a pretty big caveat. They're highlighting how their offering is different from ones with more investor protection rules like Rule 41.9. They get to bypass some of those investor safeguards because they're promising to be listed on NASDAQ and have a certain amount of assets. Here's where we see the deal with the brokers. Kingswood Capital Partners is the main underwriter. They're getting a commission of 15 cents per unit sold. That's $750,000 if they sell all the initial units. Plus they're getting 150,000 shares as extra compensation. They want to be on NASDAQ under the ticker NBRGU. Once the shares and rights split, they'll be NBRG and NBRGR. For investors in Europe, this is an offer only to qualified investors or a limited number of people. So if you're not one of those, you likely can't buy in. The auditors are sounding the alarm about the company's ability to continue as a going concern. They've got minimal cash and significant liabilities and need this IPO to survive. As of December 31, 2023, they had less than $5,000 in cash. That's basically nothing for a company wanting to buy another business. They owe almost $320,000 to their sponsor according to this balance sheet. That's a related party loan. In 2023, they lost $74,000 and the next year they lost over $140,000. They are burning cash without making it. Shareholders' deficit is negative, meaning they owe more than they own on paper. It's a bit of a mess financially speaking right now. By June 2025, they had about $10,000 in cash, slightly better, but still dangerously low, right before a big IPO. They admit their plan depends on this IPO working, and they acknowledge the substantial self-doubt about their ability to keep going without it. It's a clear sign they need this money to survive, not just grow. Their strategy is basically to find the right company and merge with it using the IPO money. They're also emphasizing their management team's experience. The CEO is the one making all the big decisions and looking at the company's performance as a whole. This means there's no complex board structure dictating strategy. Who owns most of the company? Well, the sponsor WealthPath Holdings Limited and the CEO Yongsheng Liu own a significant chunk of shares. They came in really early and cheap. Even after selling shares to the public, the sponsor is expected to hold over 1 million Class B shares. This means they'll still own almost 13% of the company after the IPO. That's a lot of voting power concentrated in a few hands. And finally, the signatures. This is where the executives officially sign off saying they believe this document is true to the best of their knowledge. Yongsheng Liu, CEO, and several directors have signed this. So what's the takeaway here? Newbridge Acquisition Limited is a SPAC looking to buy a company, but they're facing serious risks. They have little cash, a tight deadline, and potential conflicts of interest due to their sponsor's early cheap share purchase. The China connection adds another layer of complexity. The dilution for public investors is significant, and their financial health without this IPO is questionable. They need this deal to happen, and investors need to weigh the potential for a good acquisition against the substantial risks involved, especially that huge upfront dilution. And the tight timeline. A SPAC is always a bit of a gamble, and this one seems to have extra dicey odds. Alright, that's our breakdown of Newbridge Acquisition Limited's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.